So that's when you get into the frenzy stage. So I run into people all the time. I mean, I was talking to people last week. They said, Jimmy, I missed the boat on this. I should have bought it when it was 1800. Said, you have not missed anything. This party is just getting started. And if you don't have any gold, buy it now because we got a long way to run.
Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
Okay, so the first one is central bank buying. By the way, there's almost no retail interest in the United States. There is in other places, India, China, not in the U.S. And I run into people all the time, and they say, yeah, Jim, I talked to you a year ago, and then you said buy gold. And I said, yeah, did you? And they go, no, because the retail, there is no retail frenzy at all, and there's barely any retail notice. A few people are buying the GLD ETFs a little bit, but the buying is coming from institutions, in particular central banks. So we know who they are: China, Russia, India. Actually, Vietnam is a big buyer, Mexico, Kazakhstan, Philippines. You look around, and all this data is available. You just go to the World Gold Council website. You have to give me your email address, but it's free, and they have a really good database, so you can find it very easily. And they also break it down. Oh, so Turkey's another one. Iran's non-transparent, but they're buyers. So they're all buying gold as a hedge against inflation, hedge against dollar devaluation, and some of the problems we've been talking about. But the biggest hedge is that the U.S., at the beginning of the war in Ukraine, froze approximately $300 billion of Russian-owned treasury securities. Now, Russia made the money legitimately selling oil. They got paid in dollars. They took the money. They trusted us. They bought treasury securities, all different maturities, probably a lot of bills, but also intermediate-term treasury notes. And they had, trying to get the exact number, probably over 50% of their reserves in U.S. Treasury securities. But they were, because the U.S. dollar denominated, they were held mostly in a custodian in Europe called Euroclear. It's in Brussels. So Euroclear has $40 trillion of assets under custody. It's one of the largest custodians in the world. So we and the Europeans froze those assets, which is easy to do, because the Treasury and the Fed control the ledger. They're all digital. The last paper Treasury security was issued, I think, in 1978 or 79. So maybe someone's got one in their grandmother's attic, but they've been digital for decades. So they were frozen. But we're good at that. We freeze it all the time. The idea that the U.S. doesn't do it, we do it all the time. But what was different is we went a step further with Russia. We didn't just freeze them. We started to seize them, steal them, convert them to our use and NATO. And they were collateral for a $50 billion loan to Ukraine. So think of the irony. Russia makes money selling oil. They put the money in treasuries. We steal the treasuries, use it to borrow money, and give it to Ukraine to fight the war against Russia. So that's what's going on. Well, India, China, Saudi Arabia, even Japan, Taiwan, others. And some of these people have upwards of $1 trillion, not quite $1 trillion, but upwards of $1 trillion of treasury securities. Taiwan certainly does. They're looking at this and saying, wait a second, what if the U.S. wakes up and decides they don't like what I'm doing, or they don't like my policy? Are they going to do this to me? Well, how do you know? Well, one way to protect against that is physical gold. It's not digital. You can't freeze it. You can't seize it. Assuming you repatriate to your own country, put it in a nice vault, have an army, no one's going to touch it. By the way, Russia did that. In addition to, I mentioned $300 billion in treasury securities, but they had $150 billion at the time of gold, physical gold. And I would say Elvira Nabiullina, she's the head of the Central Bank of Russia. I would say she's the only central bank in the world who actually understands her job. But they put so much of their reserves in gold that has preserve them and help them get through the seizure of the U.S. Treasury securities and actually keep the Russian economy going and keep fighting the war in Ukraine. And I teach a class in financial warfare at the U.S. Army War College, and I try explaining this to the kind of mid-level career officers, lieutenant colonels, and some full colonels, and Navy commanders and others. I say, not only did they preserve those assets, $150 billion worth of gold at the time, against seizure by the United States, but the fear created by the sanctions and the kinds of things we've been talking about has caused the price of gold to go up. Again, going back to your question, which is why is gold going up? Russia has made, last time I did the math, it was 50 billion, but I imagine today it's closer to 70 billion. Russia has made $70 billion in mark-to-market profits on their gold. So, okay, we seized 300 billion, but they made 70 billion over here on the gold. So it was a very smart move by Novulina. But others are making a lot of money too. So first thing, sovereign wealth funds, but really central banks are buying gold. Look at the output side. Global gold production, total mining production has been flat for 6 years. I'm not saying peak gold. I'm not saying there's no more gold in the world. It's not going down, but it's just flat. So if you have, this is like first week in economics class, right? Increasing demand and flat supply, what happens to the price? It goes up.
Yep.
So that's an easy one. There's people say gold's an inflation hedge. That's debatable. I mean, it did go up in the 70s, but it's not as highly correlated as most people think. But gold is what I call the everything hedge. It hedges geopolitical uncertainty, wars, seizures, inflation, economic collapse, market collapse, every bad thing you can think of. Gold gets you through it. It usually does pretty well in all those scenarios. So you got central bank buying, flat output. It's the everything hedge, the uncertainty hedge, et cetera. And so those are fundamental drivers of the price of gold. But the other thing, this is kind of a psychological thing, and you know this, when you have $100 increase in the price of gold. I mean, last week it was like 30. You know, I went to bed and I woke up and it was like, I looked at the ticker, it was like 30.25. So I went down a little. I said, oh no, that's 31.25. It went up almost $100 overnight. Now, just to take $100 increments, okay, so 3,100, 3,200, 3,300. So that's the path it's on. Holders, investors think, oh, I just made $100 an ounce, or 10 times I made $1,000 an ounce, et cetera. So they tend to think in terms of those fixed dollar mark-to-market profits. But every increase is easier than the one before because you're working off a higher denominator. Again, coming back to the ratio. So if you go from $2,000 to $3,000, which we just did, that's a 50% increase. But if you go from $3,000 to $4,000, that's only a 33% increase. And if you go from $5,000 to $6,000, that's only a 20% increase. Now, it's still $1,000. You made $1,000 an ounce. Nice going. And that's how people think about it. But they lose sight of the fact that every jump is easier than the one before. So by the time you get to $9,000, what does it take to get to 10? That's only an 11% increase. That's like a good week. So that's when you get into the frenzy stage. So I run into people all the time. I mean, I was talking to people last week. They said, Jimmy, I missed a boat on this. I should have bought it when it was 1,800. Said, you have not missed anything. This party is just getting started. And if you don't have any gold, buy it now because we got a long way to run. That played out. I said that in November, and the stock market's is down almost 20%. It blew past 10%. I think it's down around 15, 16%, but it's getting close to a full 20% bear market at this stage. So that it played out as I described it. Now, one thing that Trump did really well is because he was during the campaign and a little bit in the beginning of the transition after the election, he was taking credit for the stock market because the downturn really started in December. I forecasted in November. In November, the stock market was still going up, and then December was the big turn down. But Trump was like, see, I got elected, the stock market's going up. And I told some Trump advisors, I said, do not marry the stock market. I said, the stock market goes its own way for its own reasons. It's very volatile, very unpredictable. It's a lot of emotion. And if you take credit for the stock market going up, you're going to get the blame for the stock market going down. And I think it is going to go down. So you don't want to kind of hitch your wagon to that particular start. And Trump got that message. Because he said, He said in a number of interviews, well, if stock market's going down, it's kind of like too bad. I'm focused on the big picture. I'm focused on long-term growth. I'm not focused on the day-to-day movements of the stock market. So he did a good job of separating himself, and it is going down now. Nobody thinks that's wonderful, but it is, that's really part of a normal cyclical recession that we're probably heading into. A lot of it's the Biden hangover from withdrawing fiscal policy, from all these checks that they were handing out during COVID, trying to reduce the budget deficits. And so there will be that kind of pain, and it will be reflected in the stock market. And I think Trump did a good job of distancing himself from the ticker, because would really be working against him right now. It's going to get worse. It's how much worse remains to be seen. I'm not predicting. I don't do end of the world stuff, and I don't want to say how much it could go down. Although 30 to 50% would not be highly unusual. Doesn't maybe every 10 years or so it actually does that. But let's see what happens. But we're probably going, at best case, we're going into a recession. The stock market's going to go down more. Unemployment's going to go up. The Fed, of course, will be the last to know. They're going to sit there and pause on interest rates and not cut. They should be cutting now. They're not. But cutting actually doesn't do that much. People think low interest rates are stimulus. They're not. I mean, low interest rates are associated with recessions and depressions. In a booming economy, interest rates should be 6-7%, but that would be a good thing, because it means borrowers who pay 6% think they can make 12 or 15 or more. So higher rates are actually a sign of a robust economy where there's a lot of demand for borrowing and money creation at the bank level and investment. So, but 1% interest rates or zero, thank you, Bernanke, that's a sign of recession or depression. So there's no stimulus effect, but the Fed will cut interest rates anyway because unemployment's going up and the stock market's going down. By the way, the people talk about the Powell put. This goes back to the Greenspan put, the Fed put, the Powell put, the Yellen put. The idea basically is, don't worry about the stock market, buy the dip because the Fed will bail you out. It's not true. The Fed kind of doesn't care about the stock market either. The only time the Fed gets involved is if it becomes what they call disorderly. That's one of those buzzwords, but it's the word they use. So a long, slow grind down of the kind we saw from 1969 to 1982 is not the Fed's business. A crash, the kind of thing you saw on October 19th, 1987, when it fell 20% in one day,